Welcome to the Real Estate Entrepreneurs Podcast.
Welcome to the Real Estate Entrepreneurs Podcast. This is part 2. Yesterday, we had a hiccup on the recording in between August and I. It was my fault. Actually, it wasn't my fault. It was my power's fault. So we lost power, and then we lost the internet for a while. But you know what? This gives us the chance to extend it even a little longer, because we were actually on the last 10 to 15 minutes of the podcast, August, and I was getting ready to transition to what are you doing today and this and that. And you were briefly headed, that way with what CPI is doing and how you guys are structured. So let's rewind a little bit. Let's talk about CPI and how you guys are structured and what your buy box looks like today.
Yeah, no, absolutely. For continuity purposes, I kind of dressed the same as yesterday to make sure that everything is the same.
I had a shirt and the ball cap, but I just took a shower and I didn't want to put on a ball cap. But it's good. It's good.
No. Definitely. No, I'm glad to be back here again and we can hit this off. CPI, our focus has been multifamily. The firm was created to allow initially for Canadian investors to have exposure to U.S. multifamily, a great performing asset class. But then later on, we realized that the U.S. is much larger market. So started partnering with U.S. investors as well and made a focus to be able to connect with those investors. So now we serve both. I would say our investors, the split between Canadian and U.S. investors is 70-30, I would say today. But when we look at our data, the U.S. investors are growing at a faster pace. So we just recently launched a fund in Canada as well that allows Canadians to use their retirement accounts to invest with us. But I'll get into that in a moment. But as far as our focus, again, multifamily value add, it's really a game of multifamily value add is really a game of demand, right? Demand and debt. And the property, right? So in the markets that we invest in, Florida and Texas, obviously that they've had huge population growth and huge economic growth as well, with a lot of Fortune 500 companies and other companies moving there. Both states actually individually have a larger economy than the whole country of Canada, believe it or not. Texas by itself is the 8th largest economy in the world, if it was a country. So we're talking about really a leviathan of power in both of these states. So for us, we try to leverage that. But for a deal to really economically make sense, it has to be cash flowing. It has to provide the yield. So everything starts from that kind of foundation. We look at what are the LP economics that we need to achieve to our investors, net to our investors. And for a multifamily value add, that's around 15 to 20%, right? Those are the numbers we want to achieve. So we start from there, and then we take a deal, we analyze it, we try to pull every lever possible to see if the numbers make sense. But if we're not getting anywhere close to those numbers of minimum 15% average annualized returns over the term of the project, both cash flow and the upside and the gains that a property produces, then a deal doesn't make sense. That's why in our underwriting process, we have a back of the envelope underwriting where we look at a deal, see what the whisper price is that the broker has provided us, see what our analyst team has come up with, and see what is the bid-ask spread. And if the spread is too wide, we let the broker know, and we're not going to even take the next steps, because it takes resources to do comp studies, rent comp studies, sales comp studies, to go and walk the property, due diligence. So if the number is too far off, we're not going to even bother with it. So it's been difficult to make deals pencil over the last, the last deal we closed, multifamily deal we closed was in June 2024. And prior to that, we hadn't closed on a multifamily deal for 28 months. Wow. So so now it's been, close to 4 years, and we've closed on 2 multifamily deals. So, and that, we are a smaller, more boutique firm. We're more nimble, so we don't have that huge burn rate when it comes to employees and team members, because it's difficult to gain talent and then try to retain that talent. So if the market slows down, you want to keep your guys on the team, because if you lose them, you have to go through the process of rehiring again. With CPI, because we're nimble, we can sit back and not deploy capital and wait for a more opportunistic time to enter the market. Today we're looking at in Texas and San Antonio, and sorry, forgive me, in Texas, we are looking at San Antonio, and in Florida, we're looking at Tampa. And the two markets are really drastically a lot different. When we look at a deal in Tampa Bay, and just right off the bat, when I look at the average in-place rents of the property, and I look at a per door sale price, I want to be able to achieve that 1% rule. So if the per door price is 150,000, I want my average in-place rents, the current average in-place rents, to be around $1,500. And if it's not, right off the bat, I'm like, hey, there's something off. We got to check that out. But that same rule does not apply in San Antonio. Most deals, we initially, when we entered the San Antonio market, we were looking at deals, and the deals were absolutely blowing out of the water the 1% rule. So they wanted $100,000 per door on the property, and the in-place average rents were $1,200. So we're well over that 1% rule. But when we explored this a bit more and investigated farther, we realized that the average occupancy in San Antonio is much lower, and the rent growth is much lower. Whereas in a Tampa Bay city, the average occupancy is much higher and the rent growth is higher.
Not only that, taxes are completely different from San Antonio to Tampa, right? So
exactly,
the taxes are higher in San Antonio than they are in Tampa. And even Houston is even higher than San Antonio. So you may get lower prices, but guess what? You're going to pay that price on the back end on the taxes and all of that. And in a coastal area, you mentioned you had a property here in Houston. You got to have wind insurance and flood insurance and all of that. And that also comes into account for, for your cash flow and your NOI, right?
That's right, exactly. I mean, depending on the lender that you go with, for our deal, Atlas at Bay Point in Tampa, it was a Freddie Mac loan. It was an agency loan. So we were forced to get every insurance possible under the sun. So, yeah, definitely.
How many doors minimum do you guys look at?
It's really about the economy of scale, right? And we're looking at, it's got to be 100 door plus for it really to make sense, to be able to have a third property manager, to be able to have a leasing agent, a leasing office. So we look at 100 plus doors and less than 50 million. So that's our buy box, really.
Okay, yeah. I don't know if you know Robert Martinez. He's the apartment rock star here in Houston. And he's earned a bunch of accolades, like the best apartment operator in Texas and all of that, for quite a while. And his buy box, I believe, is like, he's not looking at anything below 300 doors. Like, it has to be 300 doors. And he also has a number. I forgot what it was. But let's talk about the state of the market for a second. So what are you seeing today with all these operators that bought properties, the multifamily properties, in the last 4 or 5 years, and their loans are coming due to renew, right? Because they usually do maybe like a 20-year loan with a 5-year balloon or whatnot. And the lenders are not being flexible with them. They're, in my opinion, some of these lenders are actually trying to keep the properties, which it's mind-blowing, because the lender's job is to lend money, not to operate it. What is it, in your opinion, what's happening? What are you looking at right now as an operator?
Yeah, we're totally in a different cycle. You got to keep in mind that in 2019, the market had been on a bull run since post GFC, right? 2008 financial crisis, the mortgage-backed securities debacle resulted in the U.S. economy shrinking. The single-family home prices were reduced nationwide by 30%. And which hadn't done that. Home prices in the U.S. had gone up every single year since 1948, prior to 2008. So it was a huge. That's why it's called the Great Financial Crisis, really. And after that, the market really hit the bottom in 2011. So 2008 hits, a lot of distress, but liquidations didn't really take place until close to 2011. And that's really what happens in the market. Real estate velocity is somewhat sluggish before things happen, right? Process of purchasing real estate, foreclosure, and so on. They're much slower than going and buying a publicly traded company, for example. But 2008 bottom of the market goes on a bull run continuously to 2019. But by 2019, it seemed like we were already in mania. It seemed like there was a lot of deals taking place, a lot of exuberance, a lot of multiple offers, and a lot of aggressive situations were taking place in the commercial real estate space. And then COVID hits, everything shuts down completely, and the government has a concern. The U.S. government and governments around the world and central banks have a concern that this is going to be catastrophic for economy. People can't go to work, so they have to start printing money for people not to go to work, to stay at home, and still be able to eat and live. And that results in, just the U.S. alone, $6 trillion was printed in that period. I think it was more money printed in that period than ever before in the shortest period of time. And it resulted in inflation. People start having a lot of money. They start spending, buying things online, and the suppliers started increasing price on goods and services. So it resulted in inflation, and the Fed really has a couple of levers to pull to fight inflation, and one of them being Fed's funds rate. So they started increasing those rates, 500 basis points, 11 consecutive times, a pause, a couple of more times, and then to where we're at today to finally drop the rates for the first time. So now that was what was happening in the economy. As far as the commercial real estate, we were at the kind of, the real estate, the commercial real estate cycle really goes in recovery, expansion, hyper supply, and then after that is recession. So we were definitely in hyper supply in 2019. So it seemed like a correction was coming, but with COVID kind of restarted everything and threw a wrench in everything. With interest rates dropping, a lot of liquidity came into the market and a lot of people bought deals. Now, the same commercial real estate investors that got complacent putting in bridge debt on their deals from 2011 to 2019 had got used to doing that, and it was just fine because they were in an up market. So when rates dropped and there was this rush of capital back into the market, groups buying deals in 2021 and 2022, they start putting back these bridge debt, floating debt on their deals. Usually a lender that provides bridge debt provides floating debt. They require you to purchase a rate cap. A rate cap is basically an insurance policy. If the interest rates goes above a certain strike point, that insurance policy kicks in. So a lot of investors felt comfortable that they had a rate cap, but these rate caps expire. They're usually for the term of the bridge debt, and bridge debt is usually 3 + 1 + 1. So after 3 years, you still don't have to reapply. You just come in and you have to get a new rate. So your rate cap is expired. Rate caps in an up market, they're cheap, relatively speaking. But in a market that interest rates are high, in a tightening cycle, the rate cap prices go through the roof. So when time came in for groups to their rate caps expiring, which was around where we are 2024, 2025, those rate caps are expiring. The interest rates has gone through the roof. So when they're trying to get the new debt on their deals, it's completely wiping out their cash flow and putting them in a negative cash flow situation. The other component of it is when interest rates go up, price of debt goes up, the deals don't pencil out anymore. So price of properties come and cap rates expand. So that was another factor. The other factor was also rent growth compression. So we had rents going through the roof in both Texas and Florida, many other Sunbelt states, other areas as well, because there was so much interstate migration coming to Texas and Florida. In some places, rents went up 20% in 1 year. Organic rent growth is supposed to be historically 3%. In some areas, we had 20% rent growth in 1 year. Phoenix, for example, had 20% rent growth. So when groups were underwriting aggressively, they put these bridge debt that's supposed to be a debt that gets you from point A to point B, gets you from distress to stabilization, not a common debt you're supposed to use on a value add deal. They now got themselves not only in trouble because now they're paying a way higher price for their debt, and their income is not supporting the debt that they're producing. The rents that they're collecting is not supporting the debt service. Now the rents have also compressed, and now you have also, in some cases, you don't have the population growth that you had before, so you have issues with occupancy. So it was a perfect storm for a lot of groups to get themselves in trouble. There was a tracker where it tracked all of these commercial loans coming to mature. There was a component of also the office as well. Offices under the commercial real estate umbrella. Office is one of the asset classes under the commercial real estate umbrella. Office had a big issue with a lot of people not going back to the office. So that affected the debt environment in commercial real estate as well. But keeping the focus back on multifamily, that resulted in a lot of groups getting themselves in trouble. Now, there was a saying where I'm sure you've heard of it as well: extend till you um, extend and forget. Or there was another saying that survive till 2025. So a lot of these became common because a lot of lenders weren't foreclosing on deals. They were trying to restructure deals, trying to work with the property owners, because back in 2010, 2011, there was a lot of foreclosures taking place. Particularly when it came to a lot of lenders, they were worried about concerns such as bank runs and other issues that we saw happening with Silicon Valley Bank, that they are like, hey, let's try to support the investors. Let's not try to be rigid. Let's try to hope that the Fed will decrease rates, and they can come back to stabilize a situation. But that hasn't happened yet. And obviously there is a conflict between the Fed, which is independent, and the Trump administration has been very vocal, very vociferous when it comes to his critique of the Fed, and that the Fed should reduce rates. And I think it's really a situation where it's a kind of a yelling match, and the Fed doesn't want to reduce rates because they feel like if they do, then it seems like that there's a government involvement there. But at their last meeting, they reduced rates by 25 basis points, which was totally nominal. The rates are, relatively speaking, still pretty high for a lot of commercial real estate investors. So that's the environment we currently are in.
Not only that, August, but the single family homes. I'll give you an example. I sold my house during COVID, okay? And that house at the time, I had a 4% interest rate or something like that. It was a $600,000 home here in Houston. My mortgage was somewhere around $5,000 a month. If I want to buy the same house today, not only the house went up in price like crazy, okay, but the interest and the taxes on the property make it almost like unaffordable. So the same house I would pay $12,000 for if I bought it. But guess what?
Oh, wow.
What if I want to rent it? If I want to rent it, it's anywhere from $4,000 to $5,000 maybe. Why would I buy it when it costs me double the amount of money? And the reason why it costs double in that particular property is because of it's an upscale neighborhood, and the houses are touching $1 million. And in Texas, $1 million home pays, or not in Texas, but in Houston, somewhere around $40,000 a year in taxes. So just taxes alone is $4,000 a month. So, do the math, right? And then the mortgage and the insurance and all of that stuff. So for somebody like me, if I want to go buy a house, I'm like, I don't want to buy. I'd rather rent it right now, because even when you buy a house, if you do a 30-year long mortgage, your first 7 years is interest. You're not really amortizing to the principal. So why would I go get myself on a higher payment? And I got friends that did that. They went and bought properties for them because they wanted to own it. They want the sense of ownership. And they bought it, and I asked one of them, his name is Roberto. I said, Roberto, your house is beautiful, man. You got a pool, the whole 9 yards. What are you paying on the mortgage on this thing? And he told me like $5,000, $5,500, something like that. And I said, what if you rented it? He said, it would be $3,000. And I said, why did you buy? I just don't understand. Why didn't you do a lease option or something like that, that allows you to control the property, but you don't necessarily have to go and get a mortgage with a higher interest rate, right? And to top it off, he's in the military, so he's bound to be moved around in the next 2 or 3 years. And how does he get rid of something like that now? And a lot of those people get forced into becoming accidental landlords. They don't want to be a landlord, but that's how I got into real estate, by the way. I became an accidental landlord. And then I went and scaled that up, and then I figured I didn't like being a landlord, and then I did scale that back down and call it a day, right? But I did it on single family. I never bought any multifamily other than a fiveplex or something like that. But that's the market we're in today. It's weird. I know a lot of people want to buy properties to live on because it gives them sense of ownership. But I think if they're patient and they leave that off to the side, they can live in the same property or whatever, doing a lease option as opposed to a straight purchase. And and then save some money in the long run if that's their forever house, for instance, right? What I've seen with the multifamily operators is that some of those guys are actually getting foreclosed on, and they syndicated those deals. That means the investors' money is gone. And I mean, but that's the risk you take or I take as an accredited investor to go and put money on deals. Not everything is pretty and roses and rainbows and unicorns, right? That's part of the mitigation risk. Nobody knew that we were gonna be in this position today. Otherwise, whoever did that would have made billions of dollars on betting for it, right? But I see, man. I wanna break off from real estate a little bit, and I want to touch more on your personal side. I see your gloves back there, man. Your boxing gloves, and I saw that you went to that fight not long ago in LA. Tell me a little bit about boxing and sports regarding you.
Yeah, no, absolutely. I mean, I'm a big boxing fan. I used to box myself amateur. My dad used to box in college, so I remember seeing pictures of my dad boxing and under the lights. So my family always edified my dad being a boxer. He was amateur, just he boxed in college. So I always wanted to get into boxing, and yeah, I had a few amateur fights. Won the Golden Gloves championship, and been a fan of the sport. Followed it for a long time. These days, with CPI and the scarcity of time that I have, I don't really follow it as closely as I used to follow it. But I love the sport. I think boxing is really you can really compare boxing to life, right? Because life there, in most cases, there's nobody there. It's yourself, right? It's you have to figure things out in life. Obviously you have family, friends, and what have you. You get their support, but it's yourself. So boxing is similar as well. When you walk into that ring, there is nobody else there to help you out. You got your coach on the corner, yelling and instructions at you, but it's there. You're against the other man right there. So. A lot of great boxing analogies, old adages in boxing over the years as well, yeah, I just love the sport, and I follow it somewhat closely today.
Man, I like boxing because my grandfather from my father's side used to watch it every Friday in Venezuela. He had a hammock and he would lay on that hammock and put on the fights every Friday night. Like he didn't care who was fighting. He was literally a boxer, fan, a boxing fan. And I guess I was growing up and watching boxing, right? And I remember those old fights, Tommy Hearns and a bunch of this is previous Mike Tyson, right? And he used to always complain that that match was fixed, and probably there's something to that, but honestly, man, when you're in the ring punching another guy and he's punching you, I don't care how fixed it is. Those punches hurt, or they mean to hurt you like one way or another because somebody has to win, right?
Yeah.
But there is this movie, this Rocky movie, where, and I love all the Rocky movies, by the way. They're inspirational, but there's this particular one. It's one of the last ones, if not the last one, where he's having this conversation with his son. And he tells, his son comes to him complaining about how people are gonna see him because his dad is gonna go fight and he's 60 years old or whatnot, and what people are gonna say or think about him and this and that, and they're having this conversation on the street, and then Rocky kind of like stops him and gives him a speech, where he says, I don't know where I lost you because you were this kid that was full of dreams and full of wanting to achieve great things in life. And today you're worried about what other people think of you. And unfortunately, life is going to come at you and it's going to hit you and put you down. So he goes down that rabbit hole. And it doesn't matter how many times you get hit and you fall down, you gotta get back up and keep fighting, right? That summarizes what you just talked about, right? And
Of course.
I even want to cry when I think about that stuff because we all have gone through ups and downs in life, right? And not everything is pretty all the time. You can achieve success, but but you're gonna get punched in the mouth, right? And that's how Tyson says it, right?
Exactly.
What's your
Everybody's got it.
message? What's your message, August, for people that are watching or listening to this, coming from your boxing experience and also your business experience, and they're dealing with adversity right now?
Yeah, I mean, everything really starts from within, right? Everything starts from looking internally. I really believe the first step when it comes to, if you're dealing with adversity or in personal development, because that could be a process of personal development as well. Adversities allows us to develop ourselves as a person. Is really looking inward and acknowledging, like accepting where we're at
I see
today.
that Think and Grow Rich book over there, man. I can't keep my eyes off from it, you know?
Yes, yes. No, no, absolutely. So it's accepting where you are at today and trying to build from there. So we all have reasons. There's always been for everyone, there's been situations where we couldn't control, and that was just facts of life, who our parents were, where we were born, what life circumstances happened. Luck, for example, luck took place. But at the end of the day, we are here today where we are because of our decisions and what we have done, the decisions we've made, and uh, the the uh, the courage we had, or the lack of courage, or the energy we had to do things, or whatever it was. Right? It was our choices that resulted in where we are today. Accepting that first and building from there is probably the most important part. And I mean, today with so much information online, with so much information on the internet, with so many tools that exist, building yourself as a person, building yourself physically, building yourself mentally, building yourself economically. There's so many possibilities that really exist. If you can't do it, again, it comes back on the man itself, man or woman, but man in the sense of a figure of speech. But
There's a
yeah,
speech
life is
called The
not
Man in
easy. I
the
mean,
Arena.
yeah, exactly. So you got to also look at it that, relatively speaking, us living here in North America, Canada, U.S., we're living a lot better life as we speak today. I don't want to sound kind of a preacher type of discussion here, but there is calamities that are taking place around the world right now. If you look at it just by numbers, over 1 billion people today, as we speak right now, over 1 billion people today don't use a common toilet to go to the bathroom. They go in the bush or they go outside. They don't use a common day toilet as more modern countries use. So that just tells you where other people are in the world. People don't have access to the internet. They don't have access to uh, food. They don't have access. They're living below the poverty line in a lot of places. Aside from that, there's a lot of wars and some say genocides taking place around the world, terrorist attacks. There's a lot of terrible things that are taking place, and people there, they don't have the privilege that we have. And we get up, hey, today I have all these plans. This is my to-do list. This is what I'm going to conquer today. This is the business I'm going to start, or this is what I'm going to excel in. They're trying to stay alive and fed. They're just trying to eat food that day. So that's something that a lot of people have not dealt with in their life. This idea of just trying to feed yourself or trying to stay alive today, or making sure your family is alive. So having that back of our mind will give us the energy and enthusiasm for us to go and conquer our day and better ourselves. And really going back, I mean, to a recent book that I read, Atomic Habits, is those you know incrementals growth. You don't have to become a new man today, or build a great company today, or become a billionaire tomorrow. You have to do it incrementally. You have to do it in fractionally every day. So as long as you can achieve that, it's like working out, right, at the gym. You can't expect to be able to do heavy weights right off the bat. You got to build your way there. Or boxing as well. You can't expect to jump in with a champion day one. You have to have those fights. You have to do well in amateurs, and then go try out for the Olympics, and then become a pro. And after you become a pro, you have to be a journeyman, eventually become a contender, eventually fight the champion and get the belt from them. So that's life, really.
I love it, man. I love the self development portion that you talked about, and that's really what it comes first. Some people they want the overnight success. They want the money now, but they're not willing to work on themselves. They're not willing to like what we got here. That's the most important thing, and here in our hearts, right? And you build that throughout time. That it's not like you read a book today and tomorrow all of a sudden you're magically ready to go become whatever you want to become. It takes time, it takes dedication, it takes a lot of effort, it takes falling up and down, And you just literally summarize that, and there's something that you said, but you didn't say it in these words, which is being grateful. Being grateful for the opportunities that we have in North America, and like, comparing it to other people in the world. I've traveled the world, August, and I've been all over. I mean, and I've seen how people live, and every time I see that, I'm like, I remember my daughter, my oldest daughter, she's 27 now. She's gonna get married next year.
God
When
bless.
she was a teenager, she had a problem with like eating. Like she had an eating disorder. Like she wouldn't eat certain things, right? And I remember when I went to work in Africa, I worked in Equatorial Guinea for about a year. As soon as I got there, and I saw people like eating off trash cans and eating like whatever, drinking the water that was on the side of the road. I said, I need to bring my daughter here because she has no idea how people actually live here and the things that she's saying no to when it comes to food, right? And that comes from being gratitude. Right now, she fixed that later on. Now she eats everything. Like, she probably eats more than she's supposed to, but that comes by practicing gratitude. Being grateful for the opportunities that we have, being grateful for the challenges that we receive, because we're gonna receive challenges. It doesn't matter where we are in life. We're just dealing with different size of challenges. But I'm grateful for you, August. Thank you so much for being here today, brother. And yesterday, I know you put on the same clothes. I was gonna do the same, but I didn't want to put on a ball cap. And then I said, you know what? I'm just gonna say what happened, and that's it. August, how can people get a hold of you?
I'm very active on LinkedIn, August Biniaz on LinkedIn. I'm the only August Biniaz on there. I'm a LinkedIn top voice, so definitely reach out to me. Tell me you've seen me on Ricardo's show, and I will definitely, put some time aside for you. And maybe if you have some questions or you're working on a deal and you need some advice, please reach out to me. Yeah, our website, cpicapital.com. Check us out, and yeah, I'd love to connect and chat more about real estate and possibly partner.
Thank you so much for both days. I love this our conversation, August. You're really good at just getting going and making my job a lot easier by interviewing you. I want to interview your wife. I know she was supposed to be on the podcast, so make sure she gets on that link and she gets scheduled next.
Of
I see
course.
you guys as a power couple, and I love to get her side of the business on what it is to deal with you. So
Of
um,
course. Of course.
with that being said, don't forget to hit share, like, and subscribe, guys. We have a 10 growth in Houston, Texas, April 17th and 18th. It's going to be, and actually 19th, it's going to be a 3-day event, 2 days in English, 1 day in Spanish. And we're going to talk about all kinds of different things, all the way from single family to commercial, multifamily, and so on. So, with that being said, I'll see you on the next one. Thank you so much, August.